Before we get into today's episode, I want to ask you a quick favour. If you're getting value from any of our podcasts, and I genuinely hope you are, could you take just 30 seconds right now and leave us a rating on Apple Podcasts or Spotify? It sounds like a small thing, but a rating would make a huge difference, and it'll take less time than pouring a cup of coffee. G'day. Welcome to the AgriCoach Podcast for families on the land who want to grow their family's wealth and prosperity across the generations. I'm your host, Ben Law, and I'm the financial bloke. I've got a confession to make. I studied economics. I spent over 20 years as a financial advisor. I sat across the table from farming families through droughts, debt crises, commodity crashes, and I've always had a reasonable handle on what was going on in the world and why markets were behaving the way they were. But right now, I'm sitting here scratching my head. In late February this year, the US and Israel launched strikes on Iran. Within days, the ASX, which had just hit an all-time high of 9,202 points, crashed over 9%, down to 8,262 points. Oil surged over 55%, hitting nearly $120 a barrel at its peak. The Strait of Hormuz, through which 20% of the world's oil flows, was largely shut down. Fertilizer supply was disrupted. The IAE called it the greatest global energy security challenge in history. Now I get it. Markets panic. That made absolute sense to me. But then, markets just shrugged it off. The S&P 500, which is the US stock market, has hit brand new all-time highs above 7,100. They're up 31% year on year. The ASX, the Australian market, bounced straight back. And I'm thinking, how the bloody hell does this happen? Now, a lot of farming families I speak to are looking around thinking, wars overseas, government spending like drunken sailors, and now massive changes to the tax system, which was announced in the federal budget a few weeks ago, and yet the market just keeps marching higher. Now, to a lot of everyday Australians, it almost feels disconnected from reality. Now, I know most farming families aren't sitting there watching the ticker tape every day on the markets, but a lot of you have money in super. Some of you have off-farm share portfolios, and you hear this stuff on the news, and you wonder, should I be worried? Should I be doing something, or is this just noise? Today, I wanted to sit down with someone who actually knows how to read what's happening, not just tell us what to do with our money. And that's what your financial advisor is for. But to help us make sense of what we're actually looking at, I've got David Berthon-Jones on the podcast. David is the Joint Chief Investment Officer and founding partner of Aequitas Investment Partners, a 100% independent, staff-owned firm advising on over $8 billion of investment portfolios. He's a CFA with nearly 20 years in institutional funds management, and he has a genuine ability to explain what's happening in a global market in plain language. Now, before we start, we've got to keep those pesky lawyers happy with a disclaimer, so just bear with me. The information contained in this podcast is general in nature and for education purposes only. It's not financial advice, it's not legal advice. You should not act on the information without appropriate specific advice for your particular circumstances. I'm a former financial advisor, but choose no longer to be licensed and cannot and will not give you specific or personal advice on this podcast. Now we've got that out of the way, David, welcome to the show, mate.
I'm delighted to be here. Thank you so much for having me.
I've been really looking forward to this because this is an area, obviously, I'm really interested in. And I think we talked about this when we first talked about the episode, but I studied economics myself at university and I spent over 20 years as a financial advisor. And to be frank right now, I'm sitting here scratching my head just going, what the hell's going on? We've seen the Iran war kick off. We've seen the ASX drop around 9% from its all-time highs. Oil goes through the roof. I think it was nearly $120 a barrel. And then what happens? Markets just kind of shrug it off and then hit brand new all-time highs. How the hell is this all happening and what's going on?
Well, it's a great question, and you have brought me on here to be an expert. I must admit, to a degree, we are surprised. The market has been driven by some very good constructive things like the AI revolution, and that's a reason to be constructive on markets. But at the same time, we have the Strait of Hormuz being closed. We have inflation that is clearly pressing to the upside and it's taking interest rates with it. And that is problematic for global equity markets that are at or near all-time highs, depending on the market. So we are with you in your sense of uncertainty. We share it too. I suppose the way that we differentiate on our side of the fence where we are managing client portfolios is that we buy and sell into strength and weakness respectively. And when markets sold off as aggressively as they did, when the US launched its joint strike on Iran with Israel, we bought equities that were falling into the sea, for want of a better term. And then when the market decided that the Strait of Hormuz was not a problem and that it was really all about the earnings growth in the Magnificent Seven and wiped on all that it had wiped off, we've started to reverse that process. So we're moving back from an overweight growth position into something that's more neutral with regard to our strategic through the cycle weight. So we definitely share your confusion or nay skepticism. And I think the longer that the strait remains closed, the more pressure in the system is building. And that could well prove very problematic from here for equity markets, but not just equity markets. Of course, there's listed infrastructure, commercial real estate. The bond market is obviously suffering as yields move higher. So there are a range of things to be concerned about. Also poses some opportunities as well.
So can you paint me a little bit of a picture, if you can sort of give us the numbers? Because obviously everyone listening has got, people are going to have superannuation, they're going to have managed funds, direct shares, etc. What has the market done over the last 12 months? And what would be your examination of the market over that period of time? How would you sort of describe it?
Euphoric, I suppose. It has been incredibly strong. Equities have been a fantastic performer. It's funny to think that every April, Donald Trump does something that causes intense market gyrations. And so to your question of the past year, Liberation Day tariffs. Prior to that, US macroeconomic backdrop looked pretty good. Global growth was okay. Trade relationships were reasonably intact. And then come April a year ago, that global order was completely upended. I'm sure you'll remember when Donald held up that famous plaque and you could see tariffs of north of 65% on places as unexpected as Sri Lanka, for example, but all the way down to the high 30s for China, which is obviously an economic superpower. And had those tariffs gone into effect, we would have had a replay of the Great Depression, I think. Fortunately, Donald somewhat now famously, TARCO is the acronym, Trump always chickens out. But if we abstract from that acronym simply to say that others in the Trump administration counseled against such aggressive tariffs on trade partners, the final resultant package was watered down to a level that markets could withstand. And after having initially sold off 25%, I think the NASDAQ was off 26% in a little less than a month. The S&P 500, something similar. Europe was obviously massively affected. So was Japan. There really wasn't a country on earth that wasn't caught up in that trade dispute. Even some unoccupied regions. I think famously there was this habitat really for penguins where somehow or other they had a trade deficit with the United States. Now, of course, they don't manufacture anything, so their ability to close that trade deficit and import more cars or something from the US was probably pretty limited. But abstracting away from that, really very few markets were unscathed. It's just that sanity prevailed. The market sent a signal to the administration that this would not work. And the resulting proposals were all kind of hosed down quite dramatically. And since then, it's really been off to the races. Markets took it in their stride, but lurking in the background was this ongoing series of groundbreaking releases from companies like Anthropic, which run Claude. Off camera, when you and I were talking about how to fully integrate our audio-visual equipment in this podcast, we referenced Claude, and it's amazing. Just like the word Google, let's Google it. Claude has now become a word that we use as both noun and verb and adjective, all three things, to handle the day-to-day difficulties in our lives, from simple stuff like the audio-visual to helping research asset classes, investment opportunities, develop novel, groundbreaking new therapeutics in drug development, you name it, advances in robotics, all underpinned by these fantastic developments in these large language models, of which Claude is but one. There is, of course, the open AIs of the world, their joint partnerships with Microsoft. There's Gemini. I think Facebook has one called Llama. Maybe nobody uses that to the same extent as some of the others.
Got to be better than Siri.
Yes, the long-suffering Siri, who could definitely do with a helping hand. But these developments over the past year have really unlocked the business models of the so-called Magnificent Seven. So companies like Microsoft, like Nvidia, like Google, who were already in a really strong, commanding position. Their economic moats nigh on impregnable. But with the advent of this new technology, they have dramatically increased their level of capital expenditure to ensure that they win this AI race, this digital superintelligence race. So they're spending tremendous sums of money to make sure that they get it and the other guy doesn't, or gal doesn't. And in order to, one, unlock new business opportunities, but two, to preserve the pre-existing moats and not have them be competed away by some clever people in a basement somewhere offering those same services now at a fraction of the cost. And so that CapEx, I think, is supporting the economy at large. These LLMs require data centers, and data centers require chips and a whole bunch of other things in order to get them off the ground and up and running. And we're now talking numbers that are running to the trillions. It's common to talk about robber barons and railroads and infrastructure where billions are thrown around as a word. But once you get into trillions, once you're in the territory where describing the total quantum of expenditure with a T, you're talking really significant proportions of GDP relative to the overall size of the economy. So we think that that's been driving markets, the things that you can do with this new technology, the raw expenditure that's required to bring it about. That has been something of a rising tide lifting all boats. And it is a really compelling story. Something that we have in the back of our mind, though, is the worry that that technology, great as it is not going to be quite as great as the market capitalizations of those companies that I touched on, and a whole stream of downstream companies that are attached to that. So Nvidia, whilst people talk about it as part of the Magnificent Seven, it's really the chip maker. And there are many other chip makers, and that massive surge in demand for memory and CPUs and GPUs and whatnot, that has lifted significant parts of the S&P 500, significant parts of even places as remote as the emerging markets like Korea, Taiwan. They are very heavily exposed to that semiconductor thematic. The Taiwanese Semiconductor Corporation Manufacturing Company is an absolutely enormous part of its local index. And so you've seen markets like Korea and like Taiwan up 60, 70% over the past year. So we had that initial sell-off from Liberation Day. Then it got watered down. The trade deals were declared as victorious, even if there never really were any, or never any of great substance. Perhaps it was a shot across the bow. Perhaps it encouraged Europe to spend more on ensuring its own safety and security. Perhaps if the US is going to be a less, I don't want to say reliable trade partner, but less of a bedrock than it used to have been, then the Europeans were going to need to lift their own game. So we've seen German expenditure, fiscal deficits rise. The Germans have famously pursued, and my German is not great, in fact, it's non-existent, a Schwarz null, black zero, basically not running fiscal deficits of any size, being only attracted to trade surpluses, for example, which can kind of be akin to a beggar thy neighbour type approach, where you're reliant on ever larger deficits from trade partners inside the Eurozone. Changing that mentality through the US trade and tariff wars could well have a silver lining in encouraging those countries to reshape, indeed, in some sense, reindustrialize, remilitarize. So that's been a supportive thematic to markets. So that the fact that the trade wars kind of petered out, chickened out if you prefer, the fact that these LLMs have been so extraordinary, the fact that there's been this tidal wave of CapEx, the fact that Europe is reindustrializing, have all been really supportive to equity markets over the past year. But again, as alluded, I worry that these LLMs don't quite work the way that people think that they do.
Well, it's sniffs of the tech wreck. Succession isn't a couple of meetings and a document. It's a decade of deliberate work, and your accountant and lawyer drawing up the papers isn't where the real work happens. Our roadmap workshop is. I'll be facilitating personally over 2 days on the Sunshine Coast, August 26th and 27th. One event this year, Early bird pricing is available right now, but it won't last for long. If you've been thinking about this stuff, that's not an accident, because most people think, but only the successful take action. Go to agricoach.com.au/take action. That's agricoach.com.au/take action. Of 2000. I mean, I don't know when you started in the industry, David, but I started in
I'm getting old.
1999. And so I started in the industry just as it was all starting to take off. And I remember, I've told this story many times, that I got out of university. I had $4,000 saved in my bank account after working through uni and putting myself through. And the tech companies came out, and it was .com mania. And I remember I took my $4,000. Everyone advised me against it. Put my $4,000 into the tech fund, and 12 months later pulled out $400, which was a monumental mistake for a 21, 22-year-old to make. But it was the best lesson ever, because I'll never make that mistake again. So I suppose what I'm saying is there's a massive amount of capital flowing into these Magnificent Seven, and it's all based on just a rush to get in there, almost like a gold rush. Is there a point where earnings just outpace the growth and people start to take a more contrarian view about it? Like what's got to change for people to start to lose this gold rush mentality?
I think it's a really good question. There's a few things at play. So the useful life of these chips is not particularly long. Within a couple of years, new generation of chips have been released, and the older ones really do suffer a very high depreciation rate. And so you could make the argument that these chips, which are an enormous percentage of the overall cost of a data center, in turn, data centers being an enormous part of this total CapEx budget that we're discussing, this arms race, this gold rush, the picks and shovels being chips inside data centers to fuel LLMs. You could argue that there's some accounting chicanery, or duplicity is not the right word, but it is to a degree disingenuous, that if we ran these accelerated depreciation schedules through the Magnificent Seven P&L, the earnings, they would be a lot lower. The depreciation charges will eat into those reported profits, I think, to a degree that the market might be underappreciating, and that would mean that they are quite a bit more expensive than you currently believe them to be. And they're already reasonably expensive. These are stocks that trade collectively on price to earnings ratios in that 20 to 30 times category, and some quite a bit more than that. So they are at that area that we would traditionally call relatively expensive already. And so if you assume some more stringent depreciation schedules, you can make them look even more expensive. And when things are expensive, their forward-looking ex-ante return profile is usually weaker, meaning the returns that you get are poorer. So I think that's something to keep in mind. The second thing to keep in mind is how quickly firms will look to adopt these wonderful new shiny tools in their business practices. And whilst there has been an explosion of activity in terms of firms saying that they're doing it, it's not super obvious yet how widespread or how sustainable that phenomena will be. It's one thing to tinker with it. It's one thing to have everyone using Copilot, for example. It's quite another to have a bank hand over its credit underwriting standards to agentic AI in the hope that it doesn't hallucinate and eventually turn out to come clean and say something like, oh, I'm sorry, I didn't actually read that client's particulars when I approved the loan. I just skimmed the high-level, surface-level detail and said yes. So it's no surprise that they've defaulted on their loan subsequently. Would you like me to reread it? Which is often how these things conclude. And you've probably seen memes on the internet where it'll be a person who is expired after eating a mushroom that the LLM said was fine, and then later on said, oh, I should have checked more carefully. It was in fact poisonous and you shouldn't have eaten it. I think that the hallucinations, the ability to lie, is so problematic that we can't really hand wave it away. And so I'm left with this kind of confusing narrative for your audience where, on the one hand, I say it's incredible, it's fantastic, you can do extraordinary things with it. I use it every single day in my own line of work. And yet at the same time, it does not meet, what is it, the 6 nines? Things have to be reliable to the 99.99999%. And what I fear is that LLMs have this intractable hallucination problem based on the foundations on which they're constructed. So I don't want to be too technical, particularly in things that, frankly, I am not the best person to explain. I think almost none of us that are outside of that industry truly are. But the basic idea is that you split up words into partials. Those essentially become what are called tokens, and you use pairwise correlations all the way down to guess at what is the most likely next pairing. You can then aggregate that up into whole sentences and apply something that sounds incredibly persuasive in terms of natural language processing of unstructured data. But because it is guessing based upon the work that it has been trained on, it is always going to be, to a degree, making it up just based on mathematical likelihood because it doesn't truly understand what's been said. It says that it does, but it hasn't been. It's just been constructed based on correlations all the way down. And so that means hallucinations are going to be a feature. And unfortunately, they are a feature that is very clearly a bug. And so that's what I have in the back of my mind, that companies are saying that they're adopting it, that they're very excited by it. But when you've been using it for a long time, outside of very specific rigid domains like computer programming, software development, that issue of making things up is so problematic that I think it will affect mass adoption. The flip side of that is, what if we're wrong and it turns out actually these are correctable bugs and they are going to be fantastic for business practices everywhere, that they won't just be mere productivity improvements, they'll be utterly transformational, and that you can do your insurance underwriting or your credit underwriting or your drug development or your hospital staff rostering, or you can run your burger chain more efficiently through it. What if you can really do all of those things through agentic AI? Well, even if that's the case, do you necessarily need to be massively long the Magnificent Seven or the chip manufacturers like the NVIDIAs of the world? Because if companies can at will effortlessly implement these transformative business practices, then it will be a productivity boom everywhere. It will diffuse osmotically throughout the global economy. So even countries like Europe, which are nowhere near as advanced as the Americans in terms of their tech sector development, it would still stand to reason that companies will be able to do much more with much less, and it would be a rising tide that lifted all boats. So I guess that creates kind of an asymmetric bet. One is we're thinking it may not work as well as intended, which means the adoption and utilization won't be as good as intended, which means the return on capital will not be as strong as these investors in the S&P 500 are hoping for, in which case spreading the capital around a bit more instead of having an all-in bet on AI and the AI beneficiaries would make sense. And of course, if it does work, then it will help everyone everywhere, and you might as well spread the money around anyway, particularly in cheaper markets. So that's kind of how and where we're thinking about it.
It's complicated, isn't it? So, David, where's the panic gone? That's the one thing I'm a little bit surprised about. This is a really sort of non-technical question, but over the last 25 years, say, we've seen a lot of panic. Like the dot-com crash went down for 2 or 3 years. We saw the GFC where markets, I can remember looking at the markets back 2-3 years later, and they still hadn't recovered to where they were before. But since then to now, we've seen these sharp drops and then massive recoveries out the other side, and not just sort of recovering back to where it was, then going up ahead. What's happened to this panic? Why are we not seeing that in the market? Is there something structurally changed? Are people tuned out? I just can't get my head around why we aren't seeing that same level of sell-off and sustained sell-off. It's just a bounce straight back. What are your thoughts around that?
I think that is a brilliant question. I feel that at the level of individual, investments, individual stocks, panic and run, akin to a zebra, does seem to be the order of the day. But when you aggregate all the way up to the level of the index, it seems to wash out. And so index level volatility seems relatively unchanged, and in fact is not that high. The VIX, volatility of implied option pricing, a very common barometer for the market's level of comfort with how things are going, seems to be quite good. But disaggregating and getting down to that level of individual equities, we're finding that stocks that have even relatively modest downgrades are being punished in a way that's very different to anything that we've seen before. So it's kind of a shoot first, ask questions later. But anything with a whiff of negative earnings or price momentum is sold into the abyss. Now, as I mentioned, some individual investments, I'm going to go out of my way to say on this podcast, of course, that we're not taking into account anyone's personal circumstances, and we're certainly not making stock recommendations here on the pod. I think my compliance team require me to insert that in there. But when we look at businesses like CSL or Cochlear in healthcare, they put through downgrades that definitely do, I think, necessitate weaker share prices. But we've seen price to earnings multiples for businesses that are still profitable and, to all intents and purposes, are still expected to grow over the forward horizon over the next 3 to 5 years, where their price to earnings ratios have compressed down to levels we associate with companies that are in terminal runoff. So just using CSL again as that example, it trades on a price to earnings ratio of future earnings of about 13 times. The market multiple is closer to 17 times. That's the broader ASX 200. And so when you're trading at a 30-40% discount to market, usually you have some combination of a very weak balance sheet. Your earnings might be going backward. You have a poor competitive position. Perhaps there are many competitors in your industry and you're not particularly large within that industry, so you don't have much pricing power. That's the kind of characteristics of companies that you see that trade at 12 or 13 times earnings, where such a big discount to the broader market is warranted. And so if I try and link that back to this idea that at the individual stock level, you definitely do see signs of panic. To move to an example in consumer discretionary, there are companies like JB Hi-Fi or Nick Scali, which are very well regarded within their respective niches. If you want a good quality couch, Nick Scali has you covered. If you want to pop off to Westfield and get some interesting consumer electronics, JB Hi-Fi has that at the lowest price with a good range that's very convenient to get to with friendly staff. And yet the Australian economy, which back in December was considered to be very, very strong, 5 months later is now considered to be on the verge of recession. And those stocks have dropped enormously. Nick Scali has all but halved. Harvey Norman has all but halved. JB Hi-Fi has done the same thing. So I guess what I'm trying to paint is a bit of a picture where the market structure for individual equities does seem to have changed, where stocks with any whiff of negativity are relentlessly sold, and stocks that are experiencing positive earnings momentum are re-rated to the moon. The banking sector has been a good example of that, but a lot of that goes away when you abstract up to the level of the index. And so to your very specific question, which I've spent 5 minutes talking about anything, but it is a mystery to us that there is no greater sense of concern in the market about the prolonged exposure from closure of the Strait of Hormuz. It's not just oil that goes through that narrow body in the Persian Gulf.
Fertilizer is the big one we're worried about.
Exactly. Yes, it is all the downstream stuff, petrochemicals, agricultural feedstocks, diammonium phosphate as a key input to fertilizers. A lot of the fertilizers are downstream of natural gas, and that's not flowing either. A significant amount of refinery capacity exists in the Middle East, which is difficult to say the least in terms of getting exports out of when they're not under direct military attack. And so we really do see these looming capacity constraints, these ongoing supply shocks, as being something that the market should be factoring in, but isn't. And so the best that I think that we can do in that kind of context is to go, all right, there's some positives guiding the market like AI. There's some plausible negatives like, what if AI is a bust, that we should think about too. But then adding into that concerns that market multiples are high, equity risk premium are pretty skinny, credit risk premium are very skinny. So that's what we mean by valuations are high. And then you've got this obvious issue with the Middle East forcing the hand of central banks who heretofore were looking to ease, but now can't. It's a supply shock. It's upward pressure on inflation, and inflation was too hot. Yeah, it limits the ability of the central bank to respond, to help ward off any potential weakness in aggregate demand that might arise from that supply shock metastasizing into a demand shock. And so we think, selling some outperforming growth assets and moving back to a neutral configuration is the best way to handle the market's complacency.
It's interesting. It kind of reminds me a little bit of that movie, Don't Look Up.
Oh, yes.
I don't know if you ever saw that movie with, I think it was Leonardo DiCaprio, where the asteroid's coming towards the Earth and he sees it and goes, oh, there's an asteroid coming towards the Earth. He tries to tell everyone and everyone's like, no, don't worry about that. We'll mine that asteroid. That's a great idea. No, it'll miss it. And he said, I've done all the calculations. Obviously, I don't want to be catastrophizing, suggesting that this is going to be like an asteroid hitting the Earth. But it seems to me like I just look at Australia and I go, fuel prices are up. They're pushing interest rates up. The government's just come out with the biggest tax grab probably in living memory. Economically, our productivity is getting lower. Government spending money, so inflation's rifling through. We've got one of the largest number of bureaucrats, government employees now in the world. Like everything is pointing towards, there's a lot of headwinds for us. But everyone else seems to be thinking, no, it's full steam ahead. So I suppose that's more of a statement than a question. But where I'd like to go off to that is, what's keeping you as a funds manager and an advisor, someone who thinks about this deeply, what are the things keeping you awake at night that you're going, geez, we need to be watching these things and getting these under control?
Lots of things. I guess chief amongst them is my fear that China moves on Taiwan. That is a geopolitical risk that definitely keeps me awake.
With semiconductors and the chips.
Exactly. Yes, that's right. What would a naval blockade of Taiwan look like, and what would happen to semiconductors in that context? I think there are companies both upstream and downstream of that process, not the least of which is NVIDIA themselves, that are dependent on some of those supply chain inputs. And so you'd have the tech sector under pressure at the same time as pretty much everything else. It's also not clear how commodities would trade. So when Russia moved on Ukraine, sanctions were imposed and trade between Russia and pretty much everyone else was greatly curtailed in an effort to try and economically inflict pain on Russia, to cause them to sue or seek for peace, or basically just lay down their military ambitions. Would such tactics be applied to China, given that they are 50% of incremental commodity demand? Could you imagine Australia turning around and saying, well, we're going to do our bit to try and compel you to be what we regard as a good global citizen, and so you can't have our iron ore until you stop? That seems unlikely that we would say that, given it is our largest export.
Well, considering the tax issues we saw came out in the budget, I don't know if this government's going to be smart enough not to try and do something like that.
So yes, we are certainly, that's part of what keeps me awake at night. I think linking that question back into why is there this degree of complacency, I guess we've become inured, if that's the right word, to noises around headlines, because so much of what gets tabled subsequently gets walked back or never implemented or watered down, or one just declares victory. You can use the Iranian conflict here as an example, that perhaps emboldened by his success in Venezuela, where the administration did a surgical strike on Maduro and removed the Venezuelan leader, and to a degree, don't want to say implemented, but went with remaining members of the regime that were constructive or at least pre-approved by the Trump administration. They thought that that success was replicable over in Iran. It turns out not to have been.
Shock horror.
Who knew? Different country, different configuration, theocratic, autocratic regime, beliefs matter. And in this particular instance, he's been wildly unsuccessful, and a 2 to 3 day journey turned into a 2 to 3 week, which has now become, day 80, 70, something like that. A lot of days have gone by. Every 2 weeks, we get told that basically there's an off-ramp to de-escalation. And at some point, we just figured that Trump would get bored, wipe his hands metaphorically of the issue and leave it to the Europeans to sort out, since they're the ones that are arguably much more dependent on the hydrocarbons that flow through that region, because the US is a net energy exporter and a powerhouse in terms of producing oil and gas through their massive factor endowment of shale, that, yeah, he would just declare victory and walk away, whether it was true or not. And we've seen a bit of that before, and kind of build the wall and build some of the wall, but not all the wall, and declared victory on that, and did some of the tariffs, but not all the tariffs, and declared that it was working. And now with the military aspect, these are all things that have massively moved markets at the time, but then because they've been watered down or moved away from or de-emphasized, the market has chosen to look through it. So it's a bit like Pavlov's dogs with the conditioning. You know how the dog begins to salivate when it hears the back door open because it knows it's dinner time. It hasn't seen the food. It doesn't know that the food's coming, and yet it's reacting as if it is. So I suppose to your question of what keeps us awake at night, an unpredictable administration is part of it. And depending on my positioning on any given day of the week, I get concerned about that strait reopening or closing, depending on whether or not I've been buying or selling growth assets. But I definitely do worry that the AI trade is a bust, and that it'll become clear that LLMs weren't the right approach. And so I am afraid that there could be a 20 to 30% fall in a 36% of the market exposure, which is US tech. And to the degree that when stock markets go up, people feel wealthier, and so they spend more. There is this marginal propensity to consume out of stock market wealth that in previous times has helped keep consumption, which is a very large part of the overall economy, at higher levels than it otherwise would have been. So if you get a downturn there, we would be worried about the flow-on effects to both financial markets and to the economy, which is kind of a shorthand way of saying the same thing, really. They're symbiotic. So those are just a few examples. And then when we get to Australia, our long-running bomb that didn't go off, dog that didn't bark, has been this affordability issue in housing. So when we look around the world at other housing markets, there's a few useful shorthand measures for valuation, like dwelling price to income or dwelling price to rent. So the idea that the price of an asset has to be related to either your ability to pay for it via your income or the asset's ability to pay for itself via its rents. You can do some standardization across those metrics because different countries, different definitions. The OECD and the World Bank attempt to harmonize differences that could otherwise cloud those metrics in terms of comparisons. And when we look at those measures, it is just really, really evident that Australia is at the very upper end in terms of expensive on those metrics. We trade at much, much higher multiples than the Americans or the Europeans or pretty much anywhere else. And there have been some countries that were similar to us, Canada and New Zealand, Norway, really quite a few of the Scandinavian countries. They looked fairly similar to us in that their housing markets appeared to be extraordinarily overextended. Affordability was very low. These valuation metrics were very, very rich. And we have seen New Zealand's housing market has corrected significantly. It's down enormously in real terms from its prior peak. So not just nominal terms, which matter, but real terms, so adjusting for inflation and the purchasing power of capital. They're down a lot. And so are Canadian markets. Even UK housing markets are now down quite a bit. And Australia, to a degree, appears to be whistling past the graveyard on this measure. And we've had a really dramatic repricing of interest rates. We've had a really dramatic repricing of mortgage rates. We got to the stage where we were thinking, maybe it's enough, it's gone far enough, maybe now the RBA can ease. That's what everyone was thinking back in December. And then several very hot, very stubborn, very broad, very persistent inflation metrics hit and did away with all of that easing. So it's gone from an elevated level, maybe pricing in cuts, to from an elevated level, maybe pricing in hikes, and indeed is pricing in hikes. We've had several, but we're going to get several more in all likelihood. That's what the summary of economic projections from the RBA is telling us. That's what every investment bank and economics and strategy team is now telling us as well. That's what our own work is telling us, that our unemployment rate is 4.3 and probably a sustainable number is kind of 4.7, 4.8. So labour markets are too tight, and that begets inflationary pressure. And then, of course, something that you touched on, there's these rampant state government budget deficits. So we just had the federal budget, and yes, it's increased. There's another $10 billion of spend, and they're trying to hack a bit of money out of the NDIS and realise some savings there from a program that had probably overextended a bit relative to its original purpose. The size of the deficit scaled by GDP, which is the thing that matters, is not overly large. But when you add in the state government deficits relative to gross state product, once you add in the capital works programs, they're enormous. Queensland and Victoria are spending money hand over fist. And capital works programs, capital expenditure, those are good things to do, building roads, rail and bridges and whatnot. But if you're trying to do all of that at a time when you're already butting up against supply side constraints, availability of labour, availability of materials, it just manifests in inflationary pressure, which then the RBA reacts to. So where the chief worry that we have and the way that recessions get going in just about every example since the dawn of time is that the central bank over-tightens, causes consumption and investment to slow too dramatically in a world of fixed nominal debt contracts. If you hike up the interest rate, slow the activity, it has to be felt somewhere, and that manifests in rising unemployment and increasing business bankruptcies. So that's what we're worried about. And if that coincides with a nasty downturn in the housing market, it could become quite problematic. To be clear, this is a low probability, but it's a high impact event. So that's the one we're worried about.
Okay. So what should investors be doing? You and your business, you manage or advising on about $8 billion worth of assets. So you've got a lot of skin in the game. But if you look at the average investor out there, what's the piece of advice you'd basically give the everyday investor that's out there? I know most of our listeners are all in business or in farming businesses and investing off farm. So this isn't their day-to-day bread and butter. What should they be doing so they avoid the major mistakes in your mind?
That is a really good question. Some of it, I think, is the foundational basics, but incredibly important for financial planning. And that is ensuring that the risk profile appropriately matches the underlying investor's willingness and ability to tolerate risk. A lot of people think that they are conservative investors, and then you unpack their portfolio and you find that they're predominantly long growth assets. They're predominantly long a mix of direct equities, names that they're familiar with. Perhaps it's the BHPs and Rios of the world, the banks, rounded out perhaps with some of the insurance companies. And really that is just a concentrated, Australian-centric direct equity exposure, and there's a whole wide world out there. So some of it is the calibration of the right risk profile, the right product being fit for purpose. The other, of course, is relying on diversification as truly the only free lunch that you can have in markets. We're responding to the uncertainty of all the things that we talked about by spreading the capital far and wide. We've got a good mix of international and domestic equities. We employ some degree of portfolio hedging. So we do have unhedged exposures where the Aussie dollar acts as something of an autonomic stabiliser. Equally, we're mindful of the fact that there has been upward pressure on the AUD of late based on the stronger interest rate that you can get domestically relative to investment opportunities abroad, and that tends to result in capital flowing across the border into our market, and that pushes up the AUD. So we have some hedged exposures as well, and often that's not something that underlying clients outside of professionally managed portfolios are thinking a lot about, using that view on the currency as a way to protect, insulate, and potentially profit across the portfolio. And then I suppose the opportunities that we see for defraying equity market risk are the tried and true defensive asset class exposures like that of fixed income. And I think a lot of investors have been really worried about allocating to fixed income because for the past nearly 4 years, it was 2022 when we went through that first, rate repricing cycle where longer dated government bonds went from kind of 1.5 to 2 very low numbers to 4 to 4.5, which are, well, double, much, much higher. Before they were giving return-free risk, as the saying goes, when you were getting 1 to 1.5% on your longer dated government bond yields, you were not being appropriately compensated for all manner of risks, not the least of which is inflation, or that growth might be higher than anticipated, and thus you'll suffer mark-to-market losses on your bond portfolio. But now that you're at 4.5%, that is a really good rate of carry, we think, in an asset that is backed by the full faith and credit of the United States government for US Treasuries, or the Australian government for AGBs, Australian government bonds. And so we do have a significant exposure across our portfolio to defensive assets of that nature, and also to the world of investment grade credit. So there is a bit of a bifurcation in private credit markets from public credit markets that some of your listeners and viewers might have heard about. We don't really have any exposure to private markets. It's all public and transparent, and you can see how things are trading. You can see what the prices that you're buying and selling at are. But the point that I was going to make is that on triple Bs, that's the last bastion of investment grade credit, you're getting yields between 5.5% to 6%. The typical target of a balanced portfolio is usually around 6%. So you're getting a very long way towards contributing to the risk profile's return objective without having to take too much risk. Like the realized default rate in investment grade credit, so companies that can't service their bonds, basically, the debt of companies like Telstra, those not honouring their obligations, falling behind arrears, defaults, that kind of thing in investment grade credit are so low as to be closer to zero than to any other number. Like the realised default rate over 20, 30 years, it's almost next to nothing. And of course, your recovery rates are quite high because they're backed by collateral. There's assets underneath them. So your loss given default tends to be very, very low. And that means that the credit spread that you get, the extra yield that you're picking up for investing in investment grade credit over just the risk-free rate like treasuries or AGBs, is quite handsome and likely to be kept. Now, there may be some mark-to-market volatility around those credit spreads, but in general, that all-in number we think is quite good. The option value of cash is also not to be understated in the current environment. I think people get nervous in that if inflation goes up, people think, oh, why do I want to keep cash? I'm going to be eroding the purchasing power of my capital. I guess the answer there is that if equities tank, you'll be glad you had some, because the equities fall by 20, 30% and you lost 3% on the purchasing power of the cash. So we have found defensive assets to be quite attractive in the current environment. We are overweight that mix of intermediate duration through Aussie government bonds and US Treasuries, and then the underlying investment grade credits, and then finally complemented with cash.
It's interesting. Warren Buffett, I think I read the other day, he's got $380-something billion, I think it was, sitting in cash at Berkshire Hathaway, which is a huge war chest. So I tell you what, if we see a downturn, he's going to make more money than God, I think.
Yes, I think he's able to buy something like the next 450 companies with that war chest on the S&P 500. So it is amazing how many companies he could buy if he chose to do so.
Yeah, which he did back in the GFC. I remember, I think it was Goldman Sachs. He might have bought some options in or something like that and made a huge amount of money. So look, David, that's been pretty interesting. And it's good to hear that I'm not the only one that's sitting here shaking my head a little bit and thinking deeper and thinking, I just don't know what's going on here. And you've shed some light on a few things. There's still a lot out there that we don't really understand, I think, when it comes to the markets. And I think the reality is this is the mystery of the investment universe some way, and the way that it all technically interweaves with each other, and the obvious effects and then the unobvious effects of changes in government policy, interest rates, economic conditions, etc. So that's been really good. So, David, is there anything else you want to leave us with before we start to wind up today, and you tell us a little bit more about where people can find you online and Aequitas?
Yes, absolutely. I suppose I made the mistake of picking a company name that was a word that people are unsure of how to say. Aequitas, it is Latin for fairness and equality. I suppose partly our founding principle was this idea that fund managers overcharge and underdeliver, and we thought we could come up with a product offering that would work, that would fit in the market, that was appropriately priced, and kind of restored the balance of power between a financial planner, the advisor, and the fund manager. So that's the etymology of where the name came from. But we too run a daily blog that may interest some of your viewers, where we're writing multiple times per day on our Aequitas website about all things markets, macro, stocks, politics, economics. The odds are, if it's happened, we've written about it, and that can often make for good and interesting reading. I suppose the selfish plug from our perspective, where our clients are dealer groups, is to have your client contact their financial planner and direct interest our way. But yes, you'll certainly be able to find any amount of client-facing material on our website, and I'd encourage people to come along. I'm on Twitter as well under my David Berthon-Jones handle, where I do tweet often. Mostly I use Twitter as throwing questions into the void. If there's one thing the internet's good at doing, it's telling you when you're wrong. So you just put a view out there and then 300 people line up to tell you why that was the dumbest thing they'd ever heard. And that can be quite handy as well when you want to test your views.
Yeah, I love it. Okay, well, we'll put all those details in the show notes, the website and also the Twitter handle. So if anyone is interested, that'd be fantastic. And look, David, thanks very much for coming along today. And we'll look forward to maybe doing this Mark II in a little bit down the track if we see anything major change, if you're up for that.
A pleasure. Thanks so much for having me.
Well, that was a highly technical conversation with David. Hopefully you managed to keep up with a lot of the technical jargon, I suppose you'd say, that we were actually using. For some of you, it'll make sense. For others, it won't. But what I took away from that is the investment markets are really strange at the moment. The economy is really strange. The property market's really strange. And I don't think anything's going to change going forward. But if we want to start investing, the number one philosophy I got through there from David was diversification, not all your eggs in one basket, and be selective what you invest into and get to understand it. And if you are in the position where you don't know, go seek out advice from an appropriately qualified financial advisor, which will then help you structure a portfolio so you lose or miss most of the major problems that people that speculate or puddle in the market make. So that's it for today. If you want any more information on David or Aequitas, we've got all the information in the show notes, Twitter profile, and also he said his newsletter, which comes out, which is, from my point of view, a great read. So until next time, I'm Ben Law, I'm the Financial Bloke, and remember, it's more important who you are than what you've got. I'll see you next time.